Welcome to the deep dive. We've got this stack of market intelligence right here, the latest stock market analysis report, and we're really zeroing in on the immediate outlook, specifically the next 24 hours, June 4th to June 5th, 2025.
Yeah, and this isn't just, headlines. It's packed with the latest numbers, inflation figures, what the Fed might be thinking, labor reports, earnings, and crucially, news on specific stocks.
And our mission, well, it's pretty simple, isn't it? We want to cut through all that noise for you.
Exactly. We're going to pull out the really important nuggets of knowledge from all this data, give you a shortcut, kind of, to being well-informed about what's actually driving the market right now.
Because this report, well, it points out some genuinely surprising facts and honestly some really conflicting viewpoints that we need to look at closely.
Definitely. So we're going to try and pull out those actionable insights, tailored just for you, the listener, hopefully help you make sense of the immediate path forward.
Okay, let's dig in then.
So the first thing, and maybe the most critical point this analysis makes, is that the current market, well, it requires us to reassess, maybe even completely reassess, our prior assumptions about the economy.
Right, assess assumptions.
Yeah, the picture is just way more complex than a lot of the simple narratives out there suggest.
So the old playbook doesn't quite work. What data points are creating this complexity according to the report?
Well, it really starts with inflation. So the Cleveland Fed's nowcasting tool, it projects June 2025 year-over-year CPI, that's the price increase compared to last June, at about 2.66%.
Okay.
And core CPI, stripping out food and energy, that's projected higher, like 3.01%. Month over month looks maybe closer to 0.23, 0.24%.
And the key thing there, I guess, is that core CPI is just stubbornly sticking above the Fed's 2% target.
Driven by services, right?
Precisely. That persistence in core inflation, it's a major headache for the Fed. It's why that official BLS May CPI number coming out June 11th is just so critical. It'll either confirm the sticky picture or maybe offer some relief. Right. And speaking of the Fed, their next meeting is June 17th, 18th. That's when we get the updated projections. Yeah, see, the current rate target is what, 4.25% to 4.50%?
Yeah, effective rate was 4.33% as of yesterday, June 3rd. But what's striking is how fast expectations swung. I mean, just last month, May, the market was pricing in something like a 70% chance of a rate cut in June.
70%. And now?
Well, recent data, especially on the labor front, has really pushed those expectations back. I mean, look at the April JOLTS report job openings. It unexpectedly rose to 7.391 million openings. The expectation was more like 7.1 million.
Wow. So that suggests labor demand is still really strong, which usually means upward pressure on wages and inflation.
Exactly. But here's where those conflicting signals just hit you. The same day, we saw U.S. April factory orders fall. Like really fall, down 3.7% month over month.
3.7%, that's the biggest drop in, what, 15 months?
Yep, so you've got strong labor demand on one side hinting at inflation sticking around, juxtaposed with this sharp slump in manufacturing, hinting at an economic slowdown. And the report also notes the OECD just cut its 2025 global GDP forecast too, pointing to trade barriers, uncertainty.
So it's genuinely mixed then. Persistent core inflation, strong jobs numbers, pushing the Fed maybe more hawkish. But then slowing factory orders, global growth worries, tariffs, suggesting maybe they need to be more dovish.
It's a real policy dilemma. And for the market, that just spells uncertainty. The report also dives into corporate earnings. S&P 500 growth is still expected mid to high single digits for 2025.
Okay, that sounds decent.
It does, but the report flags that tariffs could potentially shave off, say, 2–3% from those earnings.
According to LPL Financial, right? Bringing EPS down to maybe around $255.
That's the number they cite. And the report really emphasizes that these tariff uncertainties are just this constant overhang. Even with some recent court rulings or stalled U.S.-China talks, it's still out there.
So strong beams like labor, but maybe some cracks appearing in manufacturing, global growth, all under this tariff shadow.
That tension is exactly why the report lays out these different potential market scenarios for the very near term, like the next 24 hours.
Okay, let's unpack those. What does the report see as most probable for today and tomorrow, June 4th and 5th?
All right, so based on their analysis, the highest probability scenario, they peg it at 55%, is what they're calling hawkish pause dominates.
Hawkish pause dominates. So the market pays more attention to the strong jobs data, the sticky inflation forecasts.
Pretty much. The thinking is those points carry more weight for the Fed right now than the weak factory orders. So the market keeps pushing back the timing of any rate cuts. All eyes are glued to that June 11th CPI print and the Fed meeting the week after.
And the market impact in that scenario, what would we likely see?
Probably the major indices trading in a fairly tight range, maybe with a slight downward bias. Tech stocks, being sensitive to rates, could feel some pressure. Value, defensive sectors might hold up better, relatively speaking.
And the VIX, the volatility index, it's around 18.6 now.
Yeah, it might tick up a bit in that scenario, signaling, increased uncertainty, but probably not outright panic.
Got it. Okay, what's scenario number 2?
Scenario 2, they give it a 30% probability, is mixed data indecision. This is where the market just really struggles to figure out what matters more, the strong jobs or the weak manufacturing, global growth, tariffs.
So basically confusion reigns.
Kind of, yeah. The report sees this leading to choppy, range-bound trading. You might see really rapid shifts between sectors as money tries to find a place to go. The focus tends to shift more to individual stock stories then.
Makes sense. And the least likely scenario?
That's scenario 3, only a 15% probability called dovish hopes resurface. This would mean the market suddenly decides to focus heavily on the weak data, the factory orders drop, the OECD cut, and interprets them as clear signs a slowdown is coming, forcing the Fed to cut rates sooner.
And if that happened, we'd probably see a relief rally. Tech leading the way, bond yields falling.
Right. But again, the report sees that as less likely, mainly because the market's initial reaction seemed to favor the labor data more. And that VIX level, around 18.6,
Yeah.
it tells you uncertainty is definitely priced in. But real fear, the kind that pushes the VIX up past 20, maybe 22, that aligns more with the hawkish pause scenario, the potential downside risk.
The report uses this interesting simulation and AI chain of thought to explain why the market might react like this to the mixed signals. Can you break that down?
Yeah, this part is pretty cool. It basically models how different types of traders process these conflicting signals. So you've got algorithmic traders.
The algos.
Right. They might have separate models for inflation versus growth. And an inflation-focused algo sees strong jolts, thinks wage pressure, hawkish Fed, maybe triggers some sells.
Okay.
But then a growth-focused algo sees weak factory orders, thinks slowdown ahead, maybe triggers buys in defensive stuff or treasuries. That kind of automated push and pull creates some of the choppiness.
Right, the machines fighting each other.
Exactly. Then you have the human macro traders, the strategists. They look at this and see a clear Fed dilemma. Strong labor complicates inflation, but weak manufacturing hints at trouble. Their thought process is probably something like, this is messy, I need more data. Let's wait for CPI or non-farm payrolls.
So they might hedge, reduce risk.
Probably.
Yeah.
Or maybe rotate into safer assets while they wait for more clarity.
And then there's a retail investor.
Yeah. They see a headline, strong jobs, feel bullish. Then maybe see factory orders slump, feel confused, maybe get some FUD, fear, uncertainty, doubt.
And that leads to potentially erratic trading, maybe chasing headlines.
It can, yeah, often amplified by social media chatter. So this simulation showing these conflicting reactions helps explain why the market on June 3rd was kind of positive initially, but ultimately went nowhere. The joltist reaction showed labor strength was seen as good, but the weight of everything else, weak manufacturing, global worries, tariffs, just capped the upside pretty quickly.
Yeah.
Leading to that indecision we talked about.
Okay, so that's the big picture. Indecision driven by these clashing macro signals. But even when the overall market is confused, individual stocks can make big moves based on their own stories.
Absolutely. And the report highlights 5 specific stocks that are relevant right now because of news from June 3rd and 4th. These are the stories behind some of the recent movers.
All right, let's run through them. First up, NVIDIA, NVDA.
Yep. NVDA was up almost 3% on June 3rd. Jefferies added it to their franchise picks list. It's still all about AI enthusiasm.
The AI train keeps rolling. The report mentions emotional catalysts, too.
Yeah, for NVDA, it's that powerful FOMO fear of missing out. Every analyst upgrade, every positive comment just feeds into that feeling that you have to be in it.
Okay. Then Eli Lilly, LLY, up a bit. They announced a partnership with Comerus.
Right, for cardiometabolic therapies. LOI is obviously riding that massive GLP-1 drug wave, but this shows they're also building their pipeline beyond just weight loss.
And the emotion there.
Huge expectations for those blockbuster sales, amplified by all the media hype, but also maybe some underlying anxiety about future competition, potential pricing fights down the road.
Makes sense. Now, on-N Semiconductor, on-N, that jumped 11% to over $47. What was that about?
The CEO spoke at a Bank of America conference and apparently signaled signs of demand recovery. On-N is big in chips for the auto and industrial sectors, which have been kind of slow.
Ah, so signs of a turnaround?
Exactly. Hearing the CEO address those cyclical downturn concerns hinting maybe things are bottoming out or even starting to recover. That was a huge relief for investors.
So the emotion is relief, optimism?
Yeah, relief and optimism after a rough patch, and maybe a bit of fear being left behind if the semiconductor cycle is actually starting to turn up now.
Got it. First Solar, FSLR, was also strong, up around 6.5%. Mizuho boosted their price target.
Yep. FSLR is a big beneficiary of U.S. policy, especially the Inflation Reduction Act supporting domestic solar manufacturing. So analyst upgrades tend to reinforce that positive story.
And finally, GameStop, GME. Up just fractionally. Still digesting that whole Bitcoin strategy pivot, I guess. Earnings are coming soon, June 10th.
GME is just, well, it's GME. It operates in its own universe, largely disconnected from traditional fundamentals. The emotional catalyst there is almost entirely retail sentiment, social media buzz, the roaring kitty influence, that anti-establishment vibe.
And the Bitcoin move.
The report suggests it feels like a deliberate play to align with another highly volatile asset, maybe trying to reignite that retail excitement and link GME's fate to crypto sentiment. Plus, you always have that high short interest keeping the squeeze potential simmering.
Right. Speaking of what's going on under the surface, the report looks beyond just price moves, right? At volume, options, dark pools, trying to see what the big money might be up to.
Exactly. This is where you sometimes find those more subtle signals. Like for NVDA, it flagged massive volume in the June 6th $140 call options.
June 6th, $140 calls. How massive?
Over 58,000 contracts traded on June 3rd. And importantly, about 46% of that volume looked like institutional or professional size trading.
Okay, so big players making bets on the $140 level by June 6th. What's the takeaway?
Well, that kind of concentrated volume on near-term, near-the-money calls, it suggests pretty strong bullish conviction from some large players, or maybe significant hedging. Either way, if the stock holds above $142, that activity could potentially fuel itself.
How so?
It could force market makers who sold those calls to buy the underlying stock to hedge their own risk. That buying pressure can accelerate the rally, what they call the gamma squeeze.
Interesting. So options flow giving a hint of potential near-term momentum. What about LLY?
For LLY, the report notes a persistently high off-exchange short volume ratio. It was over 51% on June 2nd, still over 46% on June 3rd.
Meaning a lot of the trading, especially short selling, is happening away from public view.
Yeah, in dark pools or directly between institutions. It could be big players building short positions, or it could just be part of normal market-making activity for a heavily traded stock.
Yeah.
But it's a notable characteristic of how LLY trades.
Okay. FSLR also had unusual options activity on June 3rd. More bullish calls than bearish puts.
Right. About $2.66 million worth of calls traded versus only $0.6 million in puts. So clearly, some options traders were betting on upside.
But
here's the conflicting part. This bullish options flow happened right after a reported insider sale by their chief supply chain officer on June 2nd.
So bullish options bets versus a potentially negative signal from an insider selling shares, that creates tension.
Exactly. Which signal proves more predictive? That becomes a key question for FSLR traders.
In GME, still high short interest, high off-exchange short volume.
Yep, no surprise there. Short volume ratio still up around 30%, short interest over 12% of the float, according to the report. That combination always keeps the potential for a short squeeze on the table, even if it's not imminent. But again, for GME, sentiment, social media, and now maybe Bitcoin correlation, they just dominate everything else right now.
Okay, so let's try and pull all this together. We've got the conflicting macro signals creating indecision. We've got these specific stock stories and catalysts, and some hints from the trading flow data. What does the report say about navigating the next 24 hours?
Well, the overall market sentiment based on this analysis is sort of cautiously optimistic after the gains on June 3rd, especially in semis, thanks to ON and NVDA.
But cautious.
Definitely cautious. That underlying indecision from the macro picture, the tariff overhang, it's still the dominant theme. The report still sees the hawkish pause or the mixed indecision scenarios as the most probable outcomes for the immediate session.
And based only on this report's analysis, it actually presents some specific ranked trade setups for these stocks. Actionable ideas for the immediate term, assuming a balanced risk profile.
That's right. These are setups derived directly from the analysis we've been discussing. The top-ranked setup is bullish on semiconductor.
On gets the top spot. Why?
Because it has the freshest, arguably strongest positive catalyst right now, those CEO comments directly tackling the cyclical worries and hinting at recovery.
Yeah.
That really resonated, especially aligning with broader positive semi-sentiment.
Okay, so the suggested action is Consider going long. If it holds above $47, maybe breaks the June 3rd high around $47.50 or $48, targeting $49, maybe $50, with a stop below $46.
That's the idea outlined, yes. Ranked second is bullish NVDA.
Makes sense given the momentum, the AI story, analyst support, and that options activity pointing higher.
Precisely. The analysis suggests looking for a long entry if it confirms a break and hold above 142 cents. Potential targets mentioned are $145, maybe 148 cents, with a suggested stop below $139.50. But importantly, the report does flag the high valuation risk with NVDA.
Good point. Rank 3 is bullish first solar FSLR.
Yep, supported by that Mizuho price target boost and those domestic manufacturing tailwinds we talked about.
So look for a long entry confirming a break above its June 3rd high, maybe $165, $161, targeting $165, $170, stop below $155.
That's the setup. And crucially, the report adds, watch the volume for confirmation on any breakout, especially given that insider sales signal lurking in the background.
Right, need to see conviction. Okay, now for the bearish side. Ranked 4 is bearish Eli Lilly, LLY, but framed as more of a short-term tactical idea.
Yeah, the thinking there is potential for some consolidation or a slight pullback after the run-up in the partnership news, especially if the broader market turns a bit more cautious.
So maybe consider a short entry if it breaks below support levels like $747 or $743, targeting perhaps $735 with a stop above $755.
That's the tactical setup described. And finally, ranked fifth, but with maybe higher conviction for downside, is bearish GameStop, GME.
Because it's so speculative and detached from fundamentals.
Exactly. The analysis suggests that without a fresh catalyst, the path of least resistance is probably lower. The idea presented is to consider a short entry if it breaks below recent support, say $29.73.
Targeting maybe $27.50 or even that 200-day moving average down around $25.50.
Those are the potential targets mentioned. But the report really stresses extreme caution here. GME is incredibly volatile. The short squeeze risk is always present, even if dormant.
And its link to Bitcoin adds another whole layer of wild unpredictability.
Got it. So these are specific ideas from this analysis for the very short term, need careful handling.
Definitely. And looking just beyond the next 24 hours, the report also highlights some beyond obvious signals or second-order effects to think about.
Like semiconductor interdependencies. Yeah. The strength in leaders like NVDA for AI and maybe recovery signs in areas like on NSERF, they don't happen in a vacuum. They can create positive feedback for the whole semiconductor sector, potentially lifting ETFs like SMH, attracting more capital into the space.
So strength begets strength in the sector. Makes sense. Another one was the tariff nuance for FSLR.
Right. This was kind of an aha moment in the analysis. Tariffs are generally seen as a macro negative, bad for global trade. But for a domestic producer like First Solar, tariffs on competitors' foreign-made panels can actually be a positive at the company level. It hurts their competition, potentially improving FSLR's market share and pricing power.
So a macro headwind becomes a micro tailwind for them. That's a great example of divergence.
Exactly. And finally, that take on GME's Bitcoin move as hype transfer.
The idea that it's less about treasury strategy, more about latching on to crypto hype.
Yeah, the analysis floats the idea that maybe it's a deliberate attempt to link GameStop's narrative and stock price to another volatile, attention-grabbing asset class. A way to maybe reignite that retail interest by tying its fortunes to crypto sentiment swings.
That's definitely a provocative thought about narrative versus fundamentals today. And of course, the report reminds us, looking further out, we've got major catalysts coming up that will really shape things.
Absolutely. Non-farm payrolls this Friday, June 7th, the official CPI release on June 11th, and that huge FOMC meeting June 17th, 18th. Those are the big ones.
So the current environment, mixed signals, catalyst-driven, maybe favoring stock picking and sector bets. That might continue for a bit.
It seems likely, yeah. Navigating it successfully means staying vigilant, monitoring the data flow constantly.
Okay, so wrapping up this deep dive, our goal really was to help you cut through some of that complexity in the current market, to understand the conflicting signals from the economy, from tariffs,
to identify the potential scenarios the market might follow in the immediate term,
and get some actionable insights based solely on this report's analysis for the next 24 hours.
And it's just so crucial to remember, markets are dynamic. Things change fast. Continuous monitoring is key.
So as you think about everything we've covered, here's that final provocative thought the report leaves us with. Consider that GameStop story. especially its recent pivot towards Bitcoin. What does that specific move really tell us about today's investing world?
Hmm.
Is it just investors searching for assets that aren't correlated to traditional stocks and bonds, or does it maybe highlight something deeper about the incredible power of narrative, online communities, and pure speculation, sometimes overshadowing traditional fundamentals in certain pockets of the market?
It really does raise fascinating questions about how value and information get processed. This hyper-connected digital trading environment we're in.
Definitely food for thought. To stay on top of how these signals evolve and to make sure you don't miss our next deep dive, which could offer crucial insights for navigating these markets, well, you know what to do. Make sure you subscribe for the fastest and most frequent updates.